What's up, guys? Welcome back to another episode of the Super Bros podcast. We are out here saving one bro at a time. This one is for the bros. So, guys, super excited to have our guest here today. I am joined by Brock Fortner. Going to introduce him in just a second, but first, make sure you like this video, subscribe, follow us wherever we're out. Do the thing on the social medias, do what you got to do, but make sure that you are tuned into what we're doing so that we can bring you the best free content to help everybody become the best version of themselves. So, like I said, joined by Brock Fortner here today. He's a good friend of mine and a very knowledgeable person. Got a cool little intro that I think is definitely par for the course on his wealth of knowledge. So let's go into that real quick. Brock Fortner is a seasoned professional and thought leader in the world of financial strategy, known for his visionary approach and commitment to empowering individuals to build a life where safety without scarcity and freedom for the life can coexist. With almost a decade of experience in the financial space, his journey towards becoming a respected figure in the industry began with a solid educational background and the abundance of mentors in his life. Brock's practice focuses on focusing with entrepreneurs and highly paid professionals across the country, including notable athletes, entertainers, and entrepreneurs. Brock holds multiple degrees, including a Master's of Science in Finance from the prestigious Vanderbilt University, where he honed his analytical skills and gained a deep understanding of financial economics. With an unwavering passion for financial freedom, Brock Fortner ventured into the industry and quickly established himself as a knowledgeable and innovative expert. He has had the privilege of working alongside some of the industry's top professionals, further enhancing his expertise. These invaluable experiences have allowed him to gain unique insights into real estate markets, investment strategies, and financial planning. That was a mouthful, but it's on the spot, man. Like you're such a smart guy. I think I met you last October. We did kind of a little intro. Yeah, and there were some things that I was looking into that was really interested in, and you just kind of opened Pandora's box, and we started digging deep into it. So, Brock, no, I just introduced you, but tell us a little bit about yourself, where you come from, and how you got started on your journey.
First, thanks for having me on. I'm glad we finally got some time to carve this out, and a beautiful Saturday morning that's just
Absolutely.
been pretty chill so far. So, and I gotta say thank you for my team to putting that together. That was pretty awesome. So, thanks to them as well. So, where I came from, I was actually born and raised in Nashville. I am now considered a unicorn, apparently, with everybody moving here. Never really thought I would be in the financial industry. I thought, I'd spend my days like everybody else playing a professional sport somewhere. But ended up getting hurt in those dreams, and then was in school to be an accountant, because that is what majority of my family did. We've got accounting departments named after us at universities. My dad went to school to be an accountant. My mom's dad was in school to be an accountant, was an accountant. Their parents, and it was just all throughout our family. And then freshman year of college, I was kind of like, I don't think I actually want to do this. So I started asking some questions of my parents, like, hey, like, how do I start the process of understanding, what do I want to do? What I want to do with my life? And so they started helping me understand the importance of really diving into looking at yourself, what your unique abilities are, what you find joy in, and then going out and testing those things. So I ended up going to some workshops, went to a workshop with that my father put on one time, and it was all about financial planning. I read a bunch of books, and finally I was like, hey, this is what I want to do. And I jumped in head first and studied a lot. And here I am today, almost a decade later.
That's awesome, man. And it just goes to show how important it is to have role models that kind of surround you with that type of thing all day. I feel like a lot of maybe my parents' generation or your parents' generation, they weren't as financially literate as maybe they wanted to be, and it just kind of perpetuates itself. So if there's nothing that you take away from today's episode, definitely make sure you're taking some notes so that you can pass it on, because really it's all about helping the next generation behind us. And I'm sure there's going to be a bunch of stuff that you got to pick up. I have no doubt in that. So you started kind of from a younger age, and then that went on into your older years, what were some of the the basics that you learned from the get-go from your parents and your family as a whole?
Yeah. So when it comes to first, one of the best things I ever learned was the fact that income is a byproduct of the value we create. And most people think that it takes money to make money, but in reality, if you just go back to the basics of exchange and where value is created and how money is created, right? If we create more value in the world, the likelihood is our income will grow by that. And so by first understanding that, something that I learned from many of my mentors was, especially one named Mike Isom. He talks to me a lot about your human life value is the source and creator of all your property value. So your human life value, those are the things, those are your unique abilities. Those are your mindsets, your skills, all the things that make up you and who you are. And there's going to be assets and there are going to be liabilities, right?
Hmm.
And that the more we grow that will help grow our property value, our balance sheet that holds our assets and liabilities when it comes to finances, savings, income, debts, assets like real estate or retirement accounts or brokerage accounts, whatever it may be. And the more that we can develop our human life value, the more that property value is just going to grow because we know more, we're able to do more, and we're able to seek out the things that we want to do.
Awesome.
Those would be the basics of basically everything that comes off of that.
So when you talk about human life value, what are some valuable skills that you think the younger generation can learn to make themselves more valuable? I think from my perspective, being one of those younger people, I'm 26 now, but when I was coming up, at high school age, wanting to figure out that one thing that would make me more money is from a young age, I've always wanted to just figure out how people do it. And it took me a while to realize that if you don't have value to bring to people, you're not going to see it in your bank account. So what do you think are some skills that might be important for people to learn?
So remember, relationship capital times mental capital equals financial capital. And so, one of the biggest things that you could learn at a younger age is communication. And
Hmm.
that, unfortunately, that is going to be a separator moving forward in our society, I believe, because of the fact of what happened with COVID and how it
Hmm.
really isolated a lot of people. And a lot of people just don't know how to communicate effectively because of that and because of social media. Most of the way that most people communicate is just behind a keyboard. But if you can learn how to communicate in person through your words at a highly effective level, you are going to surpass a lot of people, right?
Right.
And so communication would be one of those skills. Another one of those skills is, how do you network with the right people? How do you vet the people that you're going to have in your life, right? What are the things when people come into your life? How are you going to be able to filter them? Because if you have one bad relationship, that relationship can really be detrimental to not only you but also the people around you. Uh, and it's
Very
always
true.
said the 5 people you surround yourself with, that'll tell you a lot about who you are and who you're going to become. And so those would be really good ones: networking, communication, and then a third one is selling. Whether we realize it or not, everybody is selling something, whether it's a
Right.
product, a system, or themselves. Everybody is selling something to get them further in life or accomplish the things that they want to accomplish. So if you can become good at that, then there's not much you can't do.
Yeah, I think that's definitely a good point. I think one of the first experiences I had with learning how to sell something to somebody was I worked at GNC for a little while. Of course, it lines up with being a bro and
Mm-hmm.
wanting a good summer job. But when I was in college, I worked for a little while at GNC, and the common theme that I saw was when you're learning how to sell, it's not necessarily about the the dollar outcome. It's about how can I actually help this person with a problem. And I think people will pay you a lot for being able to present knowledge in a way that helps solve their problems. So that's a excellent point. Like learning how to actually want to help people and make their lives better. So great
I
skill.
think one more that we should add is discipline.
Discipline. Yeah.
You and I are very aware of discipline.
Right.
However, I think that's beginning to go away in our society. And not just discipline, but I would say diligent, intentional discipline.
Yeah.
Showing up and doing the things on an intentional matter and being diligent with the small details of our discipline. Because that discipline is going to create freedom for us, whether we realize it or not. And if you can build on top of that, a lot of things get a whole lot easier when you can have those simple disciplines in place.
Yeah, and I think it comes back to figuring out what you want to do and why you want to do it too. Like if you're just doing something, or you think something that you are doing is a goal of yours because somebody else wants you to do it, or you thought it looked cool, or this, that, and the other thing, you're not gonna be motivated to take those little actions on the day to day. And that's the hardest part, is not showing up in the moment. Like it's super easy to come out on game day and perform when a bunch of people are watching, but it's harder to make sure that you're going home and doing the little things, like increasing your human life value through knowledge gaps, like decreasing that knowledge gap, taking care of your body, taking care of your mind, making sure that your relationships are healthy. It takes a lot of discipline to do that, and you have to remind yourself why you started in the first place. And if it's not something that you want to keep doing, maybe you should reevaluate what your goals are, where you actually want to go, and what you want to do in this world. Yeah.
And you throw me another one, but the last one I would say is dream planning, vision planning, whichever one you want to call it. But like, I can't tell you how many people I come across when it comes to financial planning. And our first step is clarity. Like, hey, where do you want to go? What does life look like in 1, 3, 5, 10, 15, 20 years? You're going
Right.
somewhere, so you might as well define it, right?
Yeah.
And so if you don't have anywhere to go, that's going to be really easy to get there because any road will lead to nowhere. But
How often do you think that people should reevaluate where they're going and where they want to go?
almost every day, like,
Every day? I didn't know if it
yes,
was like a 3-month period or a 6-month period. Like I
yeah,
know that.
like now
Yeah.
the bigger stuff, right? You want to be able to sit down and say, hey, I mapped out where I wanted to be last year.
Hmm.
Here's what I said that I wanted in 3 years. All right, am I closer to that goal or further away from it? 5 years, 10 years, 15, whatever it is. So sit down at least once a year and go through it as
Right.
bare minimum.
Right.
And then, if you want to go further than that, then I would say quarterly. And if you want to go further than that, then do it monthly. And if you want to
Hmm.
go further than that, then, once a week. But you ought to be constantly looking at, where and what you want to do, where you want to go and what you want to do, because, the things that we measure typically tend to grow. And so if you can really step into that, that's going to be a incredible, you know, world that you're going to open up for yourself. And there's a good book about that. It's called The Gap in the Game by Dan Sullivan and
I'm
Benjamin
going to write
Hardy.
that down.
It's a good one. But
Yeah.
what it talks about is most people live in this world of the gap. Oh, look at that ideal self, that perfect person that I think that I want to be and all that they are. Then there's the game, which is looking back and saying, man, look how far that I've come and where I'm wanting to go.
Right.
And whether we realize it or not, if we're always comparing ourselves to an ideal person, the fact is, unintentionally, we're probably going to be taking that from a negative light. Because unfortunately, we live in a broken world and we can never be perfect. And
Right.
so we can never be that ideal self. We can always strive to be that person. But if that's all we ever do is compare ourselves to the perfect one, we're going to fall short on that. So what if instead we looked from the gain aspect of, man, look how far I've come, and how do we stack our wins on top of each other so that we can really start compounding our growth over time? And not only is our own self today going to get better, but our potential self that we see is going to get better each time as well.
That's huge, man. I actually was going through a little bit of that Instagram depression yesterday. It's one of those things that you hate to admit as a man, but you're always comparing yourself to other people, and you might not even realize it. But I find that when I see someone who's maybe doing better than me that's in my circle, like sometimes rather than being happy, I'm like, you know, like, why am I not there? And you have to kind of take a step back and remind yourself, like, there's always two sides to the story. They're only showing you the best part of it. And maybe that person's life and values don't line up with where you're at right now. And you just need to take a step back and realize, like, this could be a slower process for me because of X, Y, and Z. It's not life happening to me, it's life happening for me. And how am I going to navigate this with my circumstances? So I think that's really, really important. Do you, what do you typically try to do when you get kind of caught in that little spiral? Do you just kind of get off social media? Do you count your blessings? Like the gain portion, I think is really cool. Like remembering your resume.
I think so. First, let me address the fact, like what you just said. Like, it sucks that we deal with it. Comparison is a thief of joy, and I do have the benefit of working with a lot of these social media influencers, call them, that are always out there, and they're like, "Oh, look at this new car, look at this." And
Yeah.
I gotta tell you, every single person that we're working with on their finances, the conversation is almost exactly the same. There might just be a zero or more behind what they have.
Yeah.
Like
Yeah.
it never changes because someone's always going to be richer than you.
Mhm.
But one of the things Ryan Holiday talks about this in one of his books, but I forget, one of the Stoics was talking about the fact that everybody's running their own race. If you don't have, if you're running your own race, just run your own race, and you're only competing against yourself rather than
Mhm.
everybody else. And so, like you said, there's always two sides of the story, and one we never see.
Yeah,
And
and people's needs, they don't ever really change by type, they change by degree. So it's
hmm
like I could have a millionaire here who wants to become a multimillionaire, and I could have someone who's just trying to break into that six-figure mark. And it's like
hmm
their perspective is only fit to where they're at,
hmm
and maybe they're living beyond their needs, maybe
hmm
they're just trying to break into a new bracket of some
yeah,
kind,
yeah,
and it's all the same. It's all
yeah,
the same. So the
absolutely.
comparison game is deadly.
Yeah, it is. And for me, when I fall into that, because I'm a victim of it too, I go back to the game. Like, hey, where was I? Where am I going? Where am I today? Like, man, look at all that I've done, all that I've accomplished over these years. And it really takes, we got to sit down and just journal it out. I
Yeah.
think it was Einstein that said, our brains are for thinking, not keeping. And
Mhm.
so if you can write it down, man, just start writing out, what are the things that you're grateful for? How are you growing in these things? And so one of the things that one of my mentors, Gary Gunderson, talks about a lot is a lot of people are playing not to lose. And
Mhm.
that's set in a scarcity mindset, because when you're playing not to lose, you're really holding back on a lot
Right.
of what you're doing. Then there's the people that are playing to win, and those people are gonna, win at the cost of others. And that's
Yeah.
also in a scarce mindset. But then what happens if we win and then play? What if we design a game that's worth playing so that when we show up each and every day, we've already won, because we have already defined the terms of how we want to live our life and how we want to grow and how we want to build. If that's the
Right.
case, man, just focus on that game that you've designed, that you want, so that you're winning each and every day.
Yeah. I think there's a lot of powerful things that can come from writing your thoughts down, and I've found for me, like, even just at the end of the day, if I write down maybe what I didn't accomplish or what I want to accomplish the next day, it lays the groundwork for how I can feel fulfilled in the day by day
Yeah.
process. So,
Yeah.
transitioning from kind of that base level principle of just learning new skills and kind of sticking to your own little warpath. If somebody say we can take whatever age range you want to start with. I would, for me, from my journey, I was like 14 when I really wanted to learn about the financial freedom thing. If you were just starting out, what would you try to do to start accumulating wealth as quickly as possible?
Quickly.
Yeah. Just to set yourself up for, well, let's talk about financial freedom, what that actually is first, and then we can talk about that.
Yeah. So first, financial freedom, right, is when your passive income, or your income from your assets, is greater than your monthly expenses. and when money is no longer your excuse or decision maker in the things that you have going on.
Right.
Okay. And so when we're talking about, what's the quickest way to go from point A to point B in growing your wealth? So something that I say a lot of times, you saw it in my bio, was how do we build our financial life where safety without scarcity and freedom for life can coexist? We first need to understand that freedom without safeguards is only temporary. If you don't have safeguards in place, that freedom that you have will quickly crumble. Okay. And so you see that anywhere: drugs, alcohol,
Right.
prescriptions, whatever it is. Without those safeguards, you'll quickly crumble. And so we first got to set, where are we starting from? What's our vision? Then go to your finances. Okay. Organize your stuff. Most people I meet when they come in our practice, they're living in this financial junk drawer where they have bought these different things and they've made these financial decisions with different people at different times under different circumstances.
Right.
So they just have all these stuff in a financial junk drawer. So the first step is get organized. Okay.
Mm-hmm.
See everything on one page. Right. From there, let's look at the rules. Let's build those safeguards in place. Hey, are you saving 15% of your income?
Right.
If you're not, guess what you need to start trying to get to? Saving 15% of your income. The next is having 3 to 6 months of expenses saved up. If you don't have 3 to 6 months of expenses saved up, if something comes along, guess what? You got to go back into debt. And if you're back into debt, well, then now you're just always going to be digging a hole and then filling the hole and then digging it back up because you can't build in that safeguard, right? Yeah. After that, what we want to do is we want to be able to put in the protections in place. And most people think, protection is this necessary evil that we just have to have. The reality is that we all run on two parallel paths: the protection path and the wealth accumulation path. For us to build wealth, right, we have this thing called time value of money. And your money grows over time. And the main effect of wealth, the most growth that it has, is later in life. Okay. After you've done that compounding, after you've done all the work and the consistency of putting money where it needs to go. Those early years needs to be hedged by protection. And if you have the maximum amount of protection in place, now you can start swinging for the fences on what you're doing. You got to understand, where are you taking risk? Where are you placing your money to grow over time?
Right.
The place people forgot that they are their number one asset.
Definitely.
Right?
Definitely.
People forgot that. If you were to ask most people, they would tell you, oh, my home is my number one asset, or my 401k, or my brokerage account. You wouldn't have any of that stuff if it wasn't for you. Mm-hmm. And so we first got to realize we are our number one asset. Okay. Our number one investment is our business or career where we create an income. And this is where we want to take risk, where we have the most knowledge, expertise, experience, passion, and purpose. That is where we take risk. And then our number one strategy, which we might get into later, is anytime where we are going to relinquish control of our dollars, how do we first make sure that it's guaranteed, protected, and liquid at all times? Mm-hmm. And so what I would tell people is, make sure that you have those steps in place first. Save. Make sure you're saving. Have the savings to have staying power if things come along and try to destroy your wealth accumulation curve. Have the right protections in place, right? Because for you to reach your maximum financial potential, everything has to work out, but only one thing has to go wrong. So protect it. And, third, when it comes to building that wealth, when it comes to really expediting that growth, where do you invest first? Yourself. Because you are your number one asset. And if you can grow your income first, everything else will take care of itself.
Definitely. This is kind of a side question, but do you believe in the institution of college in general? I know you have a master's degree, but do you believe in the institution of college?
So, I'll say yes and no. So if my mother overhears this, I'll say yes, because she doesn't like me saying you shouldn't go to college. No, from the standpoint of, look, if you are wanting to be an entrepreneur, if you're wanting to be something that really doesn't need a degree, then there's really no need to go get a degree. You can go get the experience in a job. Go find a mentor, Go be an apprentice somewhere. But if you're going to be a lawyer or a doctor or somebody that really needs a degree, please go to school, because I don't want to go
Yeah,
to a doctor that
don't
doesn't
get a
have.
YouTube degree.
Yes, yes. But I will also say, like, going to college could be a really awesome thing for a lot of people. You build
Yeah,
relationships, friendships, you gain knowledge that you might not know how to get somewhere else. And, you know, yeah, I've got those degrees. Do I say that they were always worth it? No. But I'm glad I went. I'm glad I learned some of the things that I did. But,
yeah, yeah. I think you're right on the money with that. Like, if it's a highly skilled profession that requires, an advanced medical degree or something technical like that, I think it's definitely worth it. I mean, aside from all the interpersonal skills that you get, because you're kind of in a bubble in high school, and then maybe you go on and you're in another bubble, but it's just bigger. Yeah, I wouldn't recommend. I mean, looking back now, I'm like, dang, I wish I would have gone into a trade. Like, I'm interested in learning trade skills now. So there's all kinds of options, and that's another way to increase your value overall. Like,
yeah,
if you can learn one of the time honored trades,
yeah.
it's a great
I
place to
think
start too.
one of the best things somebody could do before they go into college, while they're in high school and they're getting ready to go to college, look at the people in your community, whether they go to church with you, whether they're friends with your family, whatever it is, right? If you can tell that they're doing really well, ask them if you can talk to them,
Yeah,
interview them, ask them questions, see how they got to where they are. Because the likelihood is they also have friends that are doing really
right.
well in the people
Build your
that they
network
look to.
early.
Yeah. And then you can build your network early. Now you can start asking questions of all these people that will really help you and grow you with where you want to go. And you're going to get a lot of insight before going to college.
Yeah, and it'll give you that practice of learning how to communicate well. Because it's kind of scary when you go and talk to someone that's ultra successful for the first time, and you're just kind of a young kid, and you're like, well, I don't know what to say. But if you get enough practice with it, you can potentially 10x your community, and then
Yeah.
5 years down the road, when you need somebody to lend you money for a business venture or an investment that you're interested in, like, I mean, within the last year alone, I've met you. I met tons of people within the Nashville community that are resources.
Yeah.
So it's
Yeah.
amazing what you can do just by talking to people and asking questions.
Yeah. And it doesn't stop there. Like, as you continue to grow, you want to continue to upgrade and update who you're talking to and who you're striving to be. Like, the people that I had that I was asking questions of when I started to where I am now, and the people that I'm asking questions to now, man,
Yeah.
it's upgraded so much because of those networks and growing and building and doing the things that we want to do.
Yeah. And your values will change over time, which you look back, you're like, oh, this isn't what I find important anymore. And you
Hmm.
lean into another group of people, but you still keep those
Yeah.
different circles that you talk about
Yeah.
in the beginning. And you prioritize friendships, you prioritize relationships, and it just creates a really cool network for you to access. I'm trying to think of another bigger question I have for you. What would you say your biggest financial regret is, if you have any? Have you made any
Biggest,
poor choices with money?
have I made any poor choices with money? Yeah, I didn't buy Bitcoin when I was in the fifth grade.
Yeah,
Or
same.
in my freshman year of college, all my buddies came to me and they're like, "Oh man, can we figure out how to invest in this?" And it was freshman year when Bitcoin was $10,000, and I was like, "Man, I don't know, maybe I don't." And then
Man,
we only put like $100, um,
oh my
which was
gosh.
nice, but oh well.
Yeah,
But that's besides the point. Some of the biggest regrets, early on, not having a structured system on how I handle my income, my cash flow as it comes in, not learning due diligence on the things that I invest in before I invested in them, and being very clear on my investment rules and investment criteria.
gotcha.
There's a property that I bought a couple years ago that I just, I trusted the guy who was selling it to me.
Hmm.
Still trust him today, but I should have done more due diligence on my own part and lined it up with my investment playbook to say, does this fit or does this not fit? Because you can always say no to
Right.
investments. There will always be more investments. I
Yeah.
promise. Right? I invested in a property that I thought was going to be great, and it's been nothing but a headache, constant problems. Tenant was bad, had to remove the tenant. then had to redo basically the whole house, pouring all this money into it.
Mm-hmm.
And I could have held that money instead and done something else with the last 3 years with that property instead.
Yeah, it's interesting when you look at things in hindsight, and I think there was something about this in Rich Dad Poor Dad where he brought the profit and loss sheet to his rich dad, and he's like, "Why would you ever take this deal? You're losing money." He's like, "Well, it has the potential for upside." And he's like, "No, you don't understand. Like, if you're losing money, you're not making money. Therefore, this is a bad deal." And I think a lot of people, they think emotionally versus logically when it comes to different investment opportunities. Your example was in real estate. That's something that I'm super interested in. And if you just have to put the time in and do the right thing and make sure the numbers work, and that way you can make a rational decision. What was I going to say? So with that, what are some ways that you can put, like, say I don't have the time to research my investments. What is a good way for a younger person to start saving and then compounding money without maybe looking into real estate or the stock market? Like, I've heard a lot about high yield savings account. That's something that I've utilized in the past. Talk about that a little bit.
That's a deep question. So when it comes to starting out, right, we've got what we talked about earlier, which was, follow the first 4 rules and then start investing in yourself. Because if you invest in yourself first, that'll tell you where your dollars need to go.
Mm-hmm.
A lot of times people want to chase a rate of return because they have this FOMO and they've been told all their lives, oh, you got to make sure you get compound interest and you got to invest in your Roth account or your brokerage account, whatever it is, because you're going to get 8%, blah, 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 and you're going to have this giant miracle compound interest curve and whatever it may be, right? And, what I wish people would understand is that, number one, maybe we can go into this in a little bit, but compound interest doesn't actually happen in the stock market. Like, what they tell you is, I don't want to say it's a lie, but it doesn't come true. Like, that's not real. Because
they
the
have
only
no way of knowing if that's actually going to happen or not.
Correct. And it cannot, and an account cannot compound interest if it loses money. And unfortunately, when you invest in the stock market, so different ways that you can invest in it, there's going to be taxes, there's always going to be fees, and there's always going to be market fluctuation. So that means it's going to go up and down. Over time, yeah, it might be much larger than when you started. But then, when it comes to the wealth building, now you got to understand the rules of financial institutions, corporations, and the government. Mm-hmm. I didn't know we were going to go here, but we can do this.
Hey, we can get as deep as you want to, man.
So we got to understand first of, what are the rules that we're being told to play by? They want our money on a consistent, systematic basis. Mm-hmm. They want to hold it on. They want to hold on to it for as long as possible. And then when it's time to give it back to us, they want to give it back to us in the smallest increments as possible over the longest period of time. And you might say, Brock, well, how can you prove this? Well, right. Typical financial plan, right, says a financial planner would say, okay, well, when do you want to retire? Somehow, everybody thinks that they're going to retire at 65 or 70 years old. Right. And they're going to ask you, how much income do you think you're going to need? And somehow they're going to give them a number that makes 0 sense because nobody knows what that number is going to be. Uh-huh. And so the financial advisor says, oh, that's perfect. You just need to save this amount of money every year and get this rate of return to have this nest egg.
If it actually happens.
If it actually happens. So how do they show they want our money on a consistent, systematic basis? Dollar cost average into the market, whether that's through a brokerage account, retirement account, 401k, IRA, Roth, whatever it may be, so that you can get the miracle of compound interest. Mm-hmm. And next to it, why don't you go ahead and buy term insurance to protect your family on the way there? Okay?
Yeah, we'll talk about that in a second.
Yeah. So miracle of compound interest. So there's a big difference between corporate finance and personal finance. So if you understand economics, if everyone hoarded their money, our economy would crash. A thriving economy has money that is constantly moving as what they call velocity of money. So if we look at our own personal financial life, We want money constantly moving rather than sitting still. So what they would tell you is these banks, institutions, corporations, they want your money on a consistent, systematic basis over a long period of time so you can get miracle of compound interest. Those are the first two rules, right?
Mm-hmm.
And the more money that you give them, the more money that you leave in their accounts, guess what they're doing? They're turning around and doing something else with it.
Lending it to other people.
They're lending it to other people. They're creating cash flow because they want multiple moves on a dollar. Banks, you deposit money, they turn around and lend it, right?
Yeah.
If they can
What is it? They can loan $10 for every dollar, correct?
Correct.
Okay, yeah.
And so what their goal is they want to be able to flip a dollar 6 times within the same year. That's their goal. Okay. But we need to compound our interest and only leave it in the market for the next 30 years. Save 10%, chase 10%, wait 30 years, and hopefully miracle of compound interest kicks in and saves the day. That's what we're told. Mm-hmm. So buy term insurance, because when you retire, you're going to have this really large nest egg, and you can self-insure. Well, now we roll right into the next two rules. Smallest increments possible, longest period of time. So you self-insure, you cancel your term insurance. So now that big nest egg of yours not only has to last as long as you do, but as long as your spouse does, which means there's this thing in the academic world called the safe withdrawal rate. Now, most people, because it's friendly, would say that it's 4%. Okay? Mm-hmm. So what that means is you can take 4% off of your nest egg with the hopes that you have a 98% chance of not running out of money until life expectancy. You call it 85 years old. So 20 years, okay. 65 and 85. And I'm not going to go into the fact that that 98% chance just means that you had $1 left over. Okay?
That's terrible.
That is terrible. The real academic number is 2.7%. So what that means is for every $1 million that you have, you can take $27,000 out.
Okay.
That's the two rules. Cancel your term insurance so you self-insure. Well, that automatically puts you out of control to the market with market fluctuations, to the government with the taxes, and the economy with inflation. Whereas, you learned how to create financial freedom, you learned how to buy assets on the other side of things, and you learned how to show up. And I might ruffle some feathers here. If you learned how to show up, you engineered how to show up at the day of retirement with the same amount of assets as you do permanent paid up life insurance through whole life insurance, because we all live until we don't. That means we no longer have to subject ourselves to the safe withdrawal rate. Our assets that we have in the bank, we can spin down to zero over those 20 years because it all gets replaced by the death benefit when we pass away, allowing our family to take more income throughout retirement.
Gotcha. So we'll hit on that last. We got into the weeds a little bit. Now I'm curious. We'll take a step back and we'll go forward. It's great methods like Joe Rogan, right?
That's right.
So we'll talk about mushrooms too. Talked a little bit about that. Now let's go back to once you have that 3 to 6 months savings. So say that you're, in your early 20s, you've got 3 to 6 months of expenses saved up. You're looking pretty good in case there's an emergency or something comes up called life, and you have to take out a little bit. But overall, you're really good. If somebody's working with a guy like you, what is the next step that they would take, and what might you advise them to start doing to expand their portfolio more? Because the money's sitting there. You don't want it to sit there like you mentioned earlier. How do we make it work for us?
Yeah, great question. So I'm going to try my best not to get into too much details because this is not financial advice. Don't sue me. Don't do any of that stuff.
Don't sue him. He's here on a podcast. Leave him alone.
That's our disclaimer. Not financial advice, not tax advice. Okay.
Yep.
So there's two elements here. There's the people who will bet on themselves and they're happy to invest in their knowledge and grow and do the things that they need to do to grow their own value and income. If you're not ready for that and you just say, hey, I want to grow my wealth, but I don't want to pay too much attention to it. I just want to make sure, I do the bare minimum. Mm-hmm. Totally okay. No problem with that. Step one, after you've saved the 3 to 6 months of expenses, why don't you go If you wanted to, you could go up to the match on your 401k. No more than the match, but if you wanted to, up to your match. But then we need to ask ourselves, okay? In a 401k, it's just called a pre-tax account, which means you don't pay taxes on the money that goes in, but you pay taxes on the way out. Okay? So, how old are you? Are you pretty young? Then let's ask some more questions. Do you think that you're going to make more income over time? If the answer is yes, then we probably don't need to put money in the account.
Right.
Yet. If we think that we're going to make more income, do you think that we'll pay more in taxes? The answer is probably yes. And then if we looked at the economy, we need to ask ourselves, do we think that taxes are going to go up, down, or stay the same over our working lifetime? History would show that they're probably going up. Okay?
Yep.
So if that's the case, at a young age, making small income, paying small taxes, should we defer or postpone taxes to a later date where our income will be higher and our taxes will be higher? The answer is probably no. So maybe we don't put money into the 401k first.
Right.
Maybe what we go do is we open up a Roth and we put money in a Roth account. Okay? What that means is that is post-tax. So the growth in the distribution of that money from the Roth is tax-free. Now, there are limits on the Roth. I think in 2024, it's $7,000. Could be $7,500. I'm not totally attuned to that. Okay? Then we need to say, okay, well, what happens if I'm saving more than that? Well, that could be then when you open up a regular brokerage account. And a brokerage account is an account that you put money into that invests in the stock market. Okay?
Mm-hmm.
You know, Charlie, I think it was Charlie Munger or it was Warren Buffett. Somebody said, if I had to do it all over again and I didn't want to invest the way that I did, I'd probably just put all my money in index funds and not think anything about it. So in, a safe bet, maybe you go put money in an index fund or an ETF and just let it ride. Okay.
Yeah.
What I would tell you is start growing that portfolio to a large enough amount to then at some point, if you can, if it starts producing dividends, interest, or capital gains, rather than reinvesting that stuff, take it as income so that you can begin investing in something else.
Yeah. How do you avoid oversaving? So I'm a pretty aggressive saver. That's something that I have worked to get better at, because sometimes you realize, like, I'm actually saving too much. That is a thing. What is your advice to people who, maybe not advice, but what is your guidance on best practices to avoid oversaving and be able to enjoy life more as they build their wealth?
Okay. What does oversaving mean?
Oversaving, in my eyes, it means that you are putting so much away that you cannot live at your means. So you're not able to enjoy your life. You don't have much left over at the end of the month to show for all of your hard work and your biggest leverage, which is your income. Yeah, you're just not. You don't have as much leverage as you would without it.
Yeah. And I'm going to say not so much as leverage of financial piece, but leverage of peace of mind. And so I think it is incredible to save money. But like you said, from your definition of what you just said, yeah, you would probably be correct. You could oversave to where you are scrimping and sacrificing everything just so you could have a little bit of money in the bank. Well, if we were to take a step back, you're scrimping and saving, which means you're probably, like what you just said, you're not, celebrating your hard work. You're not doing the things that are super, that would grow you. So what I would tell some people is, hey, how do you want to grow your life? If you can save 15% of your income, that would be phenomenal. Okay. If you're saving, 50%, but you're going into rough peace of mind state and you're kind of sacrificing and scrimping a lot of things in your life and you're young, you're going to be making more income. So it's okay to start somewhere of just spending a little bit of money. So maybe what you do is you open up an account and it's called a living wealthy account. And 3 to 5% of your income, you just send to that account. And then each month you get to spend that money guilt free to say, hey, I did, I did some great things, and I
Mm-hmm.
want to enjoy it. Go have a nice dinner. Go
Yeah.
take a vacation. Go buy something that you might like, right? Because your peace of mind, um, your energy is really going to push into how you handle the rest of your money. And if you're in a good state, good flow state, you're going to be better financially. You're going to start taking more chances on yourself, not
Mm-hmm.
risking something else that you don't control, but on yourself. And you're going to want to experience more. You're going to grow your human life value and grow your value in general. And so what
Yeah.
we typically find is your income grows, your life grows, you have more fun. And when you're having more fun, you start doing a whole lot better.
It's the law of abundance and the law of attraction, both operating at the same time. You know,
100%.
when you know that you've done the minimum to contribute towards your future, you're able to enjoy where you're at. And then because of that, you see things in a different perspective. Things are attracted to you. The things that you want in your life, they attract to you, they gravitate towards you.
Mhm.
And one of the most powerful things that I ever heard was don't be afraid to spend money.
Yeah,
When I
absolutely.
was 15, I was terrified of spending money because I didn't want to have to borrow from my parents. Like you have your younger person jobs or whatever, but it's like I was afraid to spend money. And then when I got older, I'm like, why am I so afraid to spend money? There's no point in having this if I can't enjoy it. So it's like
Yeah,
just spend a little bit. Be nice to yourself, but make sure that you're doing the right thing to pay yourself
yeah,
back.
yeah. I would tell you when it comes to some of the rules that I have for investing in the order in which I do it, number one is quality of life.
Hmm.
Your energy is going to help with a lot of things. So, number one for me is quality of life. Am I eating the foods that I want? Am I working with the medical team that I want? Am I doing the exercises that I want? Like the people to help me with that. And then I think about, um, you know, after it goes from quality of life, then it goes to skill set. How do I invest in a skill set? And then
Right.
the third way that I invest is how do I become a better cash flow investor? And then fourth is investing in cash flow.
Yeah. As far as cash flow goes, what would you say people should shoot for? Like maybe maybe this isn't how I want to phrase it. Is any cash flow good cash flow, or is there some opportunities that maybe aren't worth it?
There are probably some that aren't worth it. I would say it's probably not worth it if it makes you lose sleep, if it disrupts your peace of mind, right?
Hmm.
That we buy investments to better our lives, not make it worse. So don't continue to invest in something if it causes you loss and peace of mind and sleep, right?
Gotcha.
Um, but you need to write out an investment playbook, right? Of what's my investment criteria, what I want in my investments, and then my investment rules. What are the
Hmm.
rules that I want to follow in my own life for me to make a decision on investing in something? And that will help a lot. But then the good way that I kind of think about it is this is starting out, this is like the most basic level. What is a bill that I have that I don't want to pay for?
Right.
Maybe it's your phone bill starting out or your water bill, whatever it is. Okay. Can I save enough money to then figure out how to invest in an asset and that asset pays me enough money throughout the year to pay for that bill, right? If that's the case, then sure, why not?
And guys, reminder, an asset might not always be physical, it might be intellectual too. So I'll give you an example. I paid for my education. I know how to physically train people and program for them in a way that they can benefit from. That skill pays me, and I am able to charge people on a monthly basis to provide workout programs. That pays my bills.
Right.
Not all of them, but the ones that are really annoying, it covers that. Or I can put it into savings. Sometimes investing in education is the same as investing in another thing that will generate cash flow too. It's just what time frame are you looking to achieve that cash flow in? Um,
Because you are your number one asset.
absolutely,
Number one investment is your business.
absolutely. So moving into what we were kind of talking about earlier, I'll preface this with an example, right? So I think a lot of people they think that saving and spending are absolutes. You only save, and then you can only spend, and that never comes back around again. When I was first getting into the military, went through basic training, there was a number of months where I didn't, have access to my bank account. So that money was just building up, building up, building up. And then finally got access to my phone again. And I'm like, you know what? I'm going into my adult career now. I want to buy a car. So I went out, I put $9,000 down on a car that I thought was really cool, and it was used. So I thought I was doing the right thing. And then all of that money that I had built up was gone. I will never see that $9,000 again. It never comes back to me. And the same is true for any type of loan where you're paying somebody else. That money never comes back to you. I've seen it. I've heard about it. What is the infinite banking concept, and how can people apply it to their own lives?
So the infinite banking concept is a process. It is a way of handling your money and thinking about your money. So if we looked at finances, you are always either paying interest or earning interest.
Mm-hmm.
Paying somebody else interest or earning interest on your own money. What most people live in are in a saver world. They've saved all this money, right? You save, and then something comes along, whether it's an investment or something that you want to purchase, like a car, small, short-term financing, and then you deplete the account. Well, when you remove the money from the bank's balance sheet and go put it in something else in a saver's world, the bank no longer pays you interest on that money because you removed it from their balance sheet. That's
right.
Simple, okay? With the infinite banking concept, right, the most known, the most efficient, the most effective use is by utilizing whole life insurance, okay?
Okay.
Properly structured, optimally funded whole life insurance, dividend paying at a mutual insurance company. This does not work with an IUL. I can promise you that. And
Okay.
don't listen to the TikTokers because the majority of them have no idea how it works. And we've done the math and we've seen the history. It doesn't work. Don't use IULs. Don't use VULs. That's called an index universal life or variable universal life. Okay. Now, you can utilize other stuff like a home with your home equity line of credit. You could use even a margin loan on a brokerage account if it's big enough. However, there are more risks. There are things that you have to consider and think through. But what we have found is by utilizing these dividend-paying whole life insurance policies is the most effective and efficient way to utilize it. So we live in this world of what we call wealth accelerators. So you're saving money in your whole life insurance policy through what we call premiums. Okay. Mm-hmm. So you're paying these premiums. Well, as you pay these premiums, you enter into what's called the equity position that the insurance industry calls cash value. Okay. Now this cash value grows tax-free. You're going to have a guaranteed interest rate of about 3%, call it, and then you'll have dividends on top of that. So for the life of your policy, you'll earn somewhere between 4.5%, 5.5%. Okay. Over time. Mm-hmm. It grows tax-free. You can access it tax-free. And so rather than withdrawing money from this account like you would the bank account, what we do instead is we borrow against the policy and from the insurance company. So what that means is, let's say you have money in your whole life policy and you want to utilize it. So at that standpoint, you would borrow against, you would take a loan from the insurance company and they would take your policy as collateral. So they would house your policy and they would give you money from their general fund of the company. Mm-hmm. Okay. And then they would determine the interest rate on that loan, and you would determine how you pay it back, when you pay it back, and if you pay it back.
Gotcha.
But all the while that you have the insurance company's money in your hand at whatever interest rate that they said, you also still have all that money still in your whole life insurance policy, earning interest and growing over time.
Gotcha.
Okay. So throughout time, as we all know that we're going to continue saving money, we're going to continue utilizing money. If we can put it in this place that's guaranteed, protected, and liquid, that grows tax-free, we can never, anytime that we want to utilize it, we won't interrupt the compound growth, which means we're going to have a lot more money over time rather than just using a savings account.
So you're always just paying yourself, essentially. You're never never truly out of that money that you put in.
Correct. Yeah. And you're paying the insurance company back, which restores your line of credit, which means you get to utilize it over and over and over again.
That's amazing, man. How did you discover this initially? Is this something that you've known about for a long time, or is this something that you came across just in your studies?
A little bit of both. So my family's been doing it for a little over 30 years now.
Mm-hmm.
And then I'm a big reader, and I read it in about as many books as you could think. And then I invested into myself to go learn from the biggest and brightest people who utilize it, like Gary Gunderson, Todd Langford, Mike Isom, you name it. If there's somebody that has a platform and they speak about dividend paying whole life insurance, I probably have some sort of relationship with them where I bug them enough to tell me all their secrets.
Please tell me your secrets. That's cool. What book would you recommend reading to start if someone's interested in learning about this more on their own?
Yeah, so 3 books to get you started.
3.
Killing Sacred Cows, which came first, by Gary Gunderson. Disrupting Sacred Cows, which came second, by Gary Gunderson. And then What Would the Rockefellers Do, by Gary Gunderson and Mike Isom.
I have not heard of that one. That's cool. Okay.
Yeah. So those three are, phenomenal starting points that breaks it down super easy. And I think that's a good starting point. And if anybody ever actually has questions and they want to know more about it, then feel free to get with Chase and get my information, and we'll talk it out.
Yeah. I did have one more question on that. So I know that there's obviously a death benefit, and then there's a cash value that you have with that policy. Obviously, your need to borrow will always be greater than your need to receive that benefit throughout your life. But say that you want to pass this down to your beneficiaries or the people that you have structured that policy to kind of give that to them after you've passed away. Do they receive the cash value? Do they receive the death benefit, or do they receive both? How does that work?
Great question. So when you purchase a home, Chase, and you put a down payment on it and you pay your mortgage payments, right? You build equity, correct?
Mm-hmm.
And you have this mortgage that you've been paying down on. When you sell the home, do you get the equity and the house price, or just the house price?
I want to say you get both. Maybe I'm not. You're cut out just a little bit.
So
there you go.
So when you sell a house, you get the market price, right? Minus maybe any mortgage that you have on it. You don't get the equity and the mortgage, right?
Okay.
The house price.
Yeah, I see what you're saying now.
Because the net amount at risk at the mortgage company is the difference of what you own in equity and what you have on a loan.
Gotcha.
Permanent life insurance, whole life insurance is the exact same way. Just like in real estate, buy property, you have a mortgage payment, it builds equity. That equity grows to the house price. On a whole life insurance policy, you pay premiums that build equity called cash value that grows to a death benefit. Okay? Mm-hmm. So if you die, you get the death benefit. And that death benefit is way, way, way larger than the cash value. It is what's called a self-completing plan upon death. Mm-hmm. Now, if you wanted the kind of even further answer, all of these whole life insurance contracts endow. It's unilateral contract, and it endows at age 121. It used to be age 100, but now it's age 121. So if you actually did live until age 121, the insurance company would write you a full check for the death benefit, because the cash value equals the death benefit. And if you ask anybody who has a whole life policy that purchased them in the 80s, 90s, early 2000s, even 70s or 60s or 40s or 50s, it goes back to before the tax code. Life tables went to age 100, and so they all used to endow at 100. So if they had a whole life policy, they're probably getting a check soon if they live to 100 years old.
So say in the event that I pass away, right? I have this specially structured policy. When it comes time to allow my son, daughter to inherit that policy, do they pick up where I left off, or do they start contributing to that cash value from zero again?
Great question.
The death benefit is the same.
Great question. The death benefit gets paid out, so your policy ends. And hopefully they have their own policy that you've set up for them as their parent, or they are eligible to qualify for it on their own. right? Because not everybody can get the insurance. You do have to qualify for it with your health and your wealth. So hopefully that they have their own policy, and that your death benefit that you passed on will help fund that policy for them.
Gotcha. Okay. So that's kind of another way of rinse, repeat, recycle the whole process. Gotcha. Well, that's awesome. So we are just over an hour now. I've got some flash questions for you. I'm going to start doing this with all of our guests. Favorite color, go. Blue. Okay. Number one vacation spot.
Disney World.
Disney World. What part?
Magic Kingdom, but it's starting to become Hollywood Studios because of the rides.
Okay. I haven't been to Magic Kingdom yet. I've been to Hollywood Studios. That's pretty cool. Let's see. Favorite book of all time.
Other than the Bible, they're either What Would the Rockefellers Do or Disrupting Sacred Cows.
Okay. And then, do you like Dave Ramsey?
No. But
do you want to elaborate on that, or do you want to leave it at that?
I do not like Dave Ramsey due to his scarce mindset and his bullying towards people. I do see value in him because he gets people aware of their finances and does a really good job with that.
Yes.
And he has helped millions of people, and he needs to continue to do so. But I think he could change his life. And I think he's starting to see that he may be wrong on some stuff, aka one of his co-hosts called him out on something, and Dave told him to shut up and retract his statement, even though
I'm going to have to look that up. Okay.
It was on the retirement safe withdrawal method.
Okay, I'll look that up after this. Yeah, I think he's great for helping people that have like zero situational awareness, financial
100%.
awareness. So
100%.
Well, yeah. Brock, I really appreciate your time, man. Thank you for being on the podcast. We'll have to run this back again because I'm sure there's a lot more that we can get into.
For sure.
But just let's summarize the basics before we go. So start building your human life value. Save up 3 to 6 months expenses. Once you get to that point, look into other investment avenues like a Roth IRA or physical intellectual assets that will make you cash flow and also bring your value up. And then once you get to a point where it makes sense for you, start looking into how you can provide wealth for your future family. Sound about right?
Sounds about right.
Cool.
Invest in yourself first.
All right, guys. This has been another episode of the Super Bros Podcast. Thank you so much for listening. Until next time. See ya. All right, Brock. Thanks.